The Little Book of Common Sense Investing Summary. What's the story of the Little Book of Common Sense Investing? Wondering where to put your money? The Little Book of Common Sense Investing breaks it down for you. It talks about two main options: actively managed funds and index funds. In simple terms, the book suggests it's smarter to go for a low-cost index fund rather than taking risks with high-cost mutual funds. Why? Because it's a safer bet for your money. Who's the author of the Little Book of Common Sense Investing? Now, who's the brains behind this advice? Meet John C. Bogle, the founder of Vanguard Mutual Fund Group. He's got other cool books too, like the bestseller Common Sense on Mutual Funds. If you're into making your money work for you, this book is a solid guide. Who's the Little Book of Common Sense Investing Summary for anyone fascinated by the dynamics of money and investments. And for those wishing to learn how to maximize their power to their greatest benefit, why read the Little Book of Common Sense Investing Summary? Ever felt lost in the sea of mutual funds, like choosing a chocolate bar from an endless aisle? We get it. The options are overwhelming, and making the right investment decisions can be tricky. Let's talk about security. Pooling your money with others in a low-risk, well-diversified fund sounds good, right? But then there's the allure of high-risk, high-reward options, or those playing with specific stats. Confusing, isn't it? And the last thing you want is to fumble with your hard-earned cash. So, let's simplify things. This guide's got your back, making a strong case for a specific mutual fund, the index fund. In these insights, we'll break down why not all mutual funds are created equal and why index funds are your ticket to avoiding sneaky fees and expenses. In this, the Little Book of Common Sense Investing Summary, you'll learn the difference between a passive fund and an actively managed one. Why opting for the fund with the lowest fees is a no-brainer. How to sidestep those pesky market bubbles. By The Little Book of Common Sense Investing on Amazon. The Little Book of Common Sense Investing Lessons. 1. Most active funds underperform the market. Ever dipped your toes into the stock market? If you have, you've probably felt the struggle of figuring out which stocks are worth the investment. That's where actively managed funds come in, a pool of money from multiple investors, managed by a pro who tinkers with the stock portfolio based on the current market vibe. Sounds good, right? Well, not exactly. These funds come with a catch: they're pricey. As an investor, you're stuck covering brokerage commissions, the fund manager's fees, and more. These costs chip away at your potential profits. Sure, if the fund hits it big, the fees might not bother you. But here's the reality check: in the long run, actively managed funds tend to bring in less profit than the overall stock market. Why? For starters, playing the stock price guessing game isn't a sustainable strategy. Sure, it sounds cool, buying undervalued stocks and selling them when they reach their true higher value. But here's the kicker: this strategy can't outperform the actual earnings of the companies in the long haul, which is mirrored in the overall stock market's performance. Now, add those high fund costs into the mix, and what do you get? Actively managed funds delivering significantly less profit compared to a chill, low-cost index fund that simply mirrors the market's performance. Fun fact: if you tossed $10,000 into the game back in 1980, by 2005, you'd walk away with 70% less if you went with an active fund over an index fund, all thanks to those fees. Ouch. 2. Very few funds outperform the market in the long run. Okay, so you've heard about the costs of funds, but you're still thinking about diving into an actively managed one. Hold on. Before you take the plunge, let's talk performance. Truth bomb: most of these funds don't shine. In fact, many go belly up or fail to bring in substantial returns. Investors shell out big bucks for the wisdom of financial experts, but here's the kicker: only 24 out of 355 mutual funds from 1970 consistently outperformed the market and are still standing. Now, even the winners can't promise a golden future. Sure, you might spot a fund that's been rocking it lately, beating the odds. But here's the catch: past success doesn't guarantee future glory. The same conditions that made a fund shine for the last 35 years might not repeat in the decades ahead. Consider this: if a fund manager played a crucial role in past success, they'll retire at some point. What then? Will the next manager be just as stellar? No crystal ball there. Plus, future investment opportunities won't be a rerun of the past 35 years. The possibilities are unknown. It's like predicting the plot twists of a movie you've never seen. Impossible. So, before you bet on a fund for the long haul, think twice. The future's a mystery, and even the best funds can't predict it. 3. Most investors are unaware of the implications. Now that we've covered how most funds don't quite make the cut, you might be wondering why people still throw their money into them. First up, many investors are in the dark about the real costs of actively managed funds. Sure, these funds come with a hefty price tag, but here's the kicker: fund managers often keep the actual dollar amount under wraps. They love to brag about high returns, but conveniently forget to spill the beans on what you'll really earn after slicing off all those performance and portfolio fees. Shockingly, this omission is common. 198 out of the top 200 funds in the late 90s reported higher returns than investors actually pocketed. Secondly, when it comes to investing, emotions and market trends often take the wheel. People make questionable investments because they let popular opinion and savvy marketing influence their decisions. Remember the late 90s hype? A staggering $420 billion flooded into the stock market in the second half of the decade when it was booming. Why? Because everyone was doing it. But when the bubble burst, investors realized too late that they had fallen for the hype. The same principle applies to actively managed funds. People jump on the bandwagon because everyone else is doing it. So, if actively managed funds aren't the way to go, where should you park your money? Let's keep the journey going to explore some sensible alternatives. 4. Invest in a passive index fund. Now that you've got the lowdown on the downsides of actively managed funds, don't stash all your cash under the mattress just yet. There's a better option: the index fund. Here's the deal: index funds are way more wallet-friendly compared to their flashy, actively managed counterparts. These funds hold a mix of stocks reflecting the whole financial market or a specific market sector. But here's the magic: instead of playing the risky game of short-term bets, index funds hold on to their portfolios for the long haul, cutting down on those pesky operating costs. Why do they call them passive funds? Because they don't bet on individual stocks. They simply track the overall performance of all the stocks in the index. The best part? No need to cough up fees for buying and selling shares, financial consultants, or fund management. You'll still enjoy the commercial net returns. It's a win-win. Now, you might think holding on to shares forever means missed opportunities. But remember, the stock market's roller coaster eventually evens out. In the long run, index funds often outshine actively managed ones. How? By delivering returns at the real value of stocks, while kicking active management costs to the curb. Ready for the next step? The upcoming insights will guide you in choosing the perfect index fund. Stay tuned. 5. Choose the fund with the lowest cost. When it comes to index funds, it's all about picking the cheapest one. Every index fund comes with an expense ratio, covering management fees and operating expenses. Now, these costs might seem tiny, often less than 1%. But, and here's the kicker, over the long haul, like a decade, those fractions of a penny can pile up. Take the Fidelity Spartan Index Fund with its annual expense ratio of 0.007% and compare it to the JP Morgan Index Fund with 0.53%. Both are under that 1% mark, but over time, those small differences can make a dent. Since index funds tag along with the overall market, your smart move is to go for the one with the lowest cost. Here's the key: a fund's expense ratio doesn't necessarily match its performance. So, keep it simple and pocket those savings by choosing the index fund that won't pinch your wallet. Easy, right? 6. Be skeptical of new trends. When it comes to investing your money, watch out for the shiny new trends. Why? Well, the index fund world is like a bustling marketplace with 578 different funds competing for your attention. The veterans try to outdo each other by slashing costs to attract savvy investors. Meanwhile, the newcomers promise bigger rewards through fancy stock-picking methods, and yes, they often charge more for it. Take, for example, the new Copernicans. They ditch the usual methods and calculate stock proportions based on things like company profits or dividends. Sounds cool, right? But here's the reality check: figuring out which stocks are a good bet is nearly impossible, no matter the method. So, stick to the tried and true. Choose funds with a regular portfolio. Why? Because no crystal ball can tell you which new trends will be winners. Stay cautious, prioritize low costs, and you'll be on the right track. Keep it simple, keep it smart. The Little Book of Common Sense Investing Review. Actively managed funds are a money pit, gobbling up your earnings, while financial middlemen rake in the gains. The smart move? Opt for index funds to make the most of your money. Actionable advice. Rethink your investment choices. Put the bulk of your assets in an index fund for a secure, long-term investment. If you're feeling a bit adventurous, consider a small play with actively managed funds, but don't exceed 5% of your investment. Keep the majority in the safety of an index fund for steady returns. It's all about balancing risk and reward. The Little Book of Common Sense Investing Quotes. John Bogle quotes, "The greatest enemy of a good plan is the dream of a perfect plan." Stick to the good plan. The grim irony of investing, then, is that we investors as a group not only don't get what we pay for, we get precisely what we don't pay for. So if we pay for nothing, we get everything. When there are multiple solutions to a problem, choose the simplest one. The mutual fund industry has been built, in a sense, on witchcraft. At a party given by a billionaire on Shelter Island, Kurt Vonnegut informs his pal, Joseph Heller, that their host, a hedge fund manager, had made more money in a single day than Heller had earned from his wildly popular novel Catch-22 over its whole history. Heller responds, "Yes, but I have something he will never have, enough." The most important of these rules is the first one, the eternal law of reversion to the mean, RTM, in the financial markets. Buying funds based purely on their past performance is one of the stupidest things an investor can do. The two greatest enemies of the equity fund investor are expenses and emotions. The true investor will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. For finally, you can always count on Americans to do the right thing, as Churchill pointed out, but only after they've tried everything else. In the mutual fund industry, for example, the annual rate of portfolio turnover for the average actively managed equity fund runs to almost 100%. Owning the stock market over the long term is a winner's game, but attempting to beat the market is a loser's game. In 1980, the compensation of the average chief executive officer was 42 times that of the average worker. By the year 2004, the ratio had soared to 280 times that of the average worker. Investors need to understand not only the magic of compounding long-term returns, but the tyranny of compounding costs that ultimately overwhelm that magic. The index fund is a most unlikely hero for the typical investor. It is no more, nor less, than a broadly diversified portfolio, typically run at rock-bottom costs. It's amazing how difficult it is for a man to understand something if he's paid a small fortune not to understand it. Today, in our society, in economics, and in finance, we place far too much trust in numbers, pressed to identify useful financial innovations created during the past quarter century. Paul A. Volcker, former Federal Reserve Chairman and recent chairman of President Obama's Economic Recovery Board, could single out only one, the ATM. For example, trading in S&P 500 linked futures totaled more than $60 trillion. In 2011, 5 times the S&P 500 index total market capitalization of $12.5 trillion. In 1950, individual investors held 92% of U.S. stocks and institutional investors held 8%. The roles have flipped, with institutions, now holding 70%, predominating, and individuals, now holding 30%, playing a secondary role. Some estimates suggest that the failure rate is around 20%, meaning that each year, one of every 5 hedge funds goes up in smoke. The great British economist John Maynard Keynes, written 70 years ago, "It is dangerous to apply to the future inductive arguments based on past experience, unless one can distinguish the broad reasons why past experience was what it was." Gunning for average is your best shot at finishing above average. The idea that a bell rings to signal when investors should get into or out of the market is simply not credible. 3. No matter what career you choose, do your best to hold high its traditional professional values, now swiftly eroding, in which serving the client is always the highest priority. They pale by comparison to the trading volumes of hedge funds, to say nothing of the levels of trading in exotic securities such as interest rate swaps, collateralized debt obligations, derivatives such as futures on commodities, stock indexes, stocks, and even bets on whether a given company will go into bankruptcy. Over the short run, however, the fundamentals are often overwhelmed by the deafening noise of speculation, the price at which the stock market values each dollar of earnings.